Is it recording? Um, Japan's recession in 1991, known as the beginning of the lost decades, was caused by both market failure and government failure. During the 1980s, Japan experienced rapid economic growth driven by expansionary monetary policies, low interest rate, and high investors' confidence. After the Plaza Accord in 1985, the Bank of Japan's lowered interest rates, which increased borrowing and investments. This led to a massive rise in stocks and real estate prices. For example, the Nikkei stock index reached nearly 39,000 in 1989. However, these increases were both not they were not based on real economic fundamental but on speculations. The first major cause was market failure, specifically in speculative assets bubbles. Investors believed prices would continue rising forever, which led to irrational behaviors and herding effects. Capitals Capitals was mislocated into real estate and stock markets instead of productive investments. Banks also contributed by leading based off inflated asset values. This reflects imperfect information and inefficient resources allocations, which are key characteristics of market failure. When assets prices stopped rising, the bubble collapsed, leading to a sharp economic downturn. The second cause the second cause was government failure, especially weak financial regulations. Banks were also banks were allowed to engage in risky lendings without strict oversight. Regulators failed to enforce proper lending standards or limit exposure to speculative markets. There were also close relationships between banks and regulators, which reduced accountability. Because of lack of regulations, financial risks built up in the system, making the event collapse much worse. In response to the recession, the Japanese government used both fiscal policies and monetary policies. First, they introduced large fiscal stimulus packages, included infrastructure, spending, and subsidies to increase ag- aggregate demands and create jobs. Second, the Bank of Japan implemented monetary easing by lowering interest rates and increased money supplies. The goal was to encourage borrowing, investments, and consumer spendings. Although these policies helped in the short term, they were not very effective overall. Fiscal stimulus projects were often delayed and inefficient. The banking system remained weak due to non-performing loans. Monetary policy also struggled because banks were unwilling to lend and businesses were hesitant to borrow. As a result, Japan experienced prolonged economic stagnation known as the lost decade. The policies used by Japan were mainly based on Keynesian economics. Keynesian theory suggests that during a recession, the government should increase aggregate demands through spending and lower interest rates. Japan clearly followed this approach by using fiscal stimulus and expansionary monetary policies to boost the economy. There is strong evidence of this, including repeated government spending programs and near zero interest rates. However, there are also some elements of monetarist policies, especially in the focus on controlling money supplies. Overall, Keynesian economics was the dominant approach because the government actively inverted to stimulate demands. Although Japan took action, there were several important mistakes. First, the government was too slow to fix the banking system. Banks kept bad loans for too long, which reduced lending. A better approach would have been a faster bank recapitalization and stricter regulations. Second, fiscal stimulus was often efficient inefficient, but much of spending went towards unnecessary infrastructures instead of productive investments. The government could have focused more on technology and innovation. Third, monetary policies was not aggressive enough early on. The Bank of Japan delayed stronger actions like quantitative easing, which allowed deflation to worsen. Finally, the government did not implement enough structural reforms such as improving financial regulations and increasing competition. In conclusion, Japan's recession showed how both market failure and government failure can lead to long-term economic problems. While the government attempted to fix the situation using Keynesian policies, delays and inefficiencies limited their effectiveness. This can demonstrate that strong regulation, timely invertation, and well-targeted policies are essential for economic stability.